Okay, there we go. Welcome to Converge. Today, I'm very excited to welcome Daniel. Oh, sorry, Daniel, I didn't ask you. Is your name pronounced Eidan or Eidan?
Both are equally wrong, but equally okay.
What's correct?
The first one is good. The first one's good. Eidan is good. Yes.
Okay. Hi, everybody, and welcome to Converge. I'm excited to have Daniel Eidan and now my four-time guest and co-host Micky Tesfaye from the team at Money 2020 back. Daniel is an advisor and solution architect at the Bank for International Settlements in the Innovation Hub, where he builds technology solutions for the central banking community with a special focus on blockchain and CBDCs. So that'll largely be the focus for today's discussion, given Daniel's expertise. Daniel, thanks so much for being here. In your own words, could you add a bit more around what you do at BIS, your background before joining BIS, and what brought you to the world of payments?
Yes. Thank you for having me. It's a pleasure to be here. So maybe I'll give a broad kind of 10,000 foot view on what the BIS is, and then what the Innovation Hub within the BIS is, and then kind of how I found myself as part of the organization. So the BIS stands for the Bank for International Settlements. It's a bank that's been around for over 90 years, and it's a very special institution in the sense that we're colloquially called the Bank of Central Banks. So our exclusive clients and shareholders are the central banking community. We have 63 members in total across the globe, and we service all of the central banks around the world. The bank traditionally provided two main functions. The first one was kind of banking services. So you can think of things like reserve management and banking services that central banks have, open market operations, things like that. And the second one that we're probably more better known for is a forum for convening on different topics. So the BIS is the home of a lot of very, very important committees that really set the standards for banking supervision, payments, and insurance, and on and on and on. So without going into the alphabet soup of all the different committee names, that's kind of what we've done as a conventional kind of convening function. The latest addition to the Bank for International Settlements is the Innovation Hub. The Innovation Hub has been around for about 3 years now, and the Innovation Hub, I mean, as its name implies, is to innovate within the central banking world, and that's where my role comes in. So I've been at the Innovation Hub for almost 3 years, so almost from the very beginning. I originally started my role with the Innovation Hub out of our Hong Kong office. So I was located in Hong Kong for just over a year. And now I've spent just about a year and a half or two in Switzerland. So now I'm calling out of our Swiss center. We have 7 locations around the world. Switzerland, Singapore, and Hong Kong were the first. And then it followed with our London center, our Nordic center, our EU center, our Canadian center, and we have joint partnership with the Federal Reserve Bank of New York.
Great.
So what do we do? I guess that's the next question. We essentially bring innovation into the central banking world, and I think about it like we connect between two very different stakeholders. One is the central banking community and the need of central banks to continuously innovate. This isn't really a new thing. There's innovation in central banking consistently from the beginning of central banks. So the innovation in payments isn't anything new. So we shouldn't think about it as if it's a AI thing or a blockchain thing. Innovation in central banking functions is an ongoing requirement of staying relevant, because that's what it is. So we keep a focus on what the needs of central banks are around the world, and of course that varies by jurisdiction. And then we keep a focus on what's going on in the technology space, and we really try to marry those two things together. And how that comes together is through the form of very kind of hands-on projects. So we focus on proof of concepts and prototypes and pilots, and we really try to showcase technology solutions, mostly around the feasibility of the technology within the realm of central banking. So we assume there's a certain desirability. So if we're talking about payments, for example, the desire of to improve on cross-border payments, I think that's something that is not directly in our remit. So we get the desirability from the G20, the G7, different types of forums that will articulate these requirements. And then we come in and help test out the technical feasibility and some of the contours of these solutions, and specifically try to raise the policy issues to the decision makers that are relevant. So for example, we can build a prototype, test different technologies, and try to map out what trade-offs different implementations have, and then leave it to the central banks to actually decide which ones they want to take and run with, and maybe push to production, how specifically they want to do the setup and things like that. I guess the last part of your question that I'll address is how I came to sit where I'm sitting today. It's a little bit of a meandering path through my career, but my background is computer science and engineering. I worked as an engineer for a while. I led delivery teams across different types of technology stacks. Then I spent some time in education and technical education, where I helped kind of build a lot of content and ran kind of technical education boot camp courses, basically. And then almost by coincidence, I got involved in the crypto community very, very early on. I was based out of Toronto at the time, and a lot of the early crypto people came from Toronto, so I had the opportunity to intersect with them in a way that today seems very, very casual considering where things are today. And then I started working for a company called R3, who built Corda, and just circumstantially, the Bank of Canada very, very early on had the foresight to engage with CBDC in a project called Project Jasper. I worked on Project Jasper through R3, and then from there, kind of worked on a lot of central banking projects between then and joining the BIS. So by the time I joined the BIS, I'd have some depth of knowledge with central banks around the world on a lot of the different CBDC projects that were going on.
Yeah, I'd imagine. Yeah, thanks for sharing. That's a really interesting background, and thank you for the context on the BIS in general. I think we can definitely turn the conversation to some of what you mentioned around how BIS is advising on central banks' interest in improving global cross-border payments. So if you could, what in your view or BIS's view and just the view of the industry in general are some of the biggest pain points today in global cross-border payments and settlements, and how can CBDCs help address, or new technologies and CBDCs help address these issues from your view?
Yeah, so cross-border payments is a great place to start. I think in general, for anybody, just on a personal experience level, for anybody, and sorry, maybe before I go into that, I forgot to give my disclaimer intro that I usually forget to give until the very end, so I'll try to remember this time. Really, any opinions that I express here are really my own and not necessarily the opinions of the institution. Okay, so with that out of the way, cross-border payments in general are expensive, they're slow, and they're opaque. So you generally pay high fees. You generally don't really know when the recipient of the payment will actually receive the payment, and you don't know where the payment is in the duration of that time that it takes it to get from the payee to the payer. Now, there's different reasons to that, and I'm not going to suggest that CBDC can solve everything, because that's likely not the case. But it comes down to this fundamental issue that cross-border payments are almost a byproduct of the way they weren't an explicit requirement when the financial system was designed the way it was designed. So it almost was something that we didn't think about when we built our central banks and we built our payment systems and so on and so forth. So it has been solved through private sector solutions, big banks with holding liquidity across different countries, nostro-vostro accounts, correspondent banking, all kinds of things like that. And in general, it's worked for a long time and it's worked very well. But as our economies become more digital, the borders between the countries and the trade flows between countries increase, the requirements of cross-border payments all of a sudden increase with that, right? When I go to an online retailer, I live in Switzerland right now, I couldn't care less where my product is really coming from, let alone the supply chain that leads to that product, right? So there's a lot of money moving across borders, and the payment systems that underpin those flows simply weren't designed to do that. So there's been a lot of Band-Aid solutions that were put on top of it. So if you think about those three things, they're expensive, they're slow, and they're opaque. Let's take two very distinct examples that can bring those to life. The first one is, on the retail side, let's go to the smallest denomination that you can have one-way remittance flows from foreign workers from one larger economy generally to a smaller economy. Those remittances are incredibly expensive. They're incredibly slow. And the people that send the money generally have no concept of if it's received, how it's received, and what's going on in between. So there's kind of a use case there that's very, very obvious, right? Why do we need to send money around like this, specifically when the people that are sending this money around need it most? Then there's a different use case, same problems, expensive, slow, and opaque, when you think about wholesale payments. So you can think about let's take an example of a corporate treasury. So I'm a big corporate. I have offices all around the world. I need to make payroll in Hong Kong next Monday, but it's a banking holiday, and I need to move, X amount of money in the millions from one place to the other. There's settlement risk. It takes time. It's expensive, and I need to mobilize capital across the globe in a way that's frictionless and easy and transparent. And today's solutions, there are active things out there that are trying to resolve some of these things, and some of them are quite successful. But I think to bring it back into CBDC and central bank innovation, what we're really talking about is the base layer of money. And what we're really thinking about is, how does this base layer of money, central bank money, M0, the safest form of settlement asset available to our society, can this be re-engineered to facilitate these use cases as an explicit requirement, not an after-the-fact kind of arrangement? So that's kind of the lay of the land. Those are the problems, and CBDC could be something that would help solve this.
That's great response. So just to quote a report that I saw that you had co-authored under the Bank of International Settlements, there was a quote that I think gives some context to the next question. And it was summing up some of the projects that have been worked on relating to CBDCs and experimentation with them across different central banks. And it said that the projects show that platforms with 2 or more CBDCs are technically feasible and offer a range of benefits that can lead to faster, cheaper, and more transparent payments across borders. While this is desirable, questions remain unanswered related to policy considerations, legal and regulatory frameworks, and basic operational economics that might call into question the viability of multi-CBDC platforms. So since this report was published almost 2 years ago now, or it was in 2022 at some point, with regards to policy considerations, legal and regulatory frameworks, and basic operational economics, where do these things stand now? And have we seen progress in addressing these issues or roadblocks? And if so, how close are we to turning these test projects into action on the ground? And Micky, if you have anything you want to add to this, feel free. But I know it's it's going to be a broad answer there.
Micky, anything from your side?
No. Go ahead. I'll come back in afterwards.
Sounds good.
Okay. Thank you. So yeah, I mean, as you very accurately bring out, I think with a lot of our MCBDC work, so MCBDC work in general stands for multi-CBDC platforms. And like I said at the beginning of our conversation, we've shown the technical feasibility of a lot of these solutions, and kind of to a large extent, a lot of the friction now is in this, taking it from something that I would think about as like a laboratory, or maybe we took it out of the laboratory and we ran it once around the racetrack, right, in a very kind of controlled environment, just saying, okay, well, what does it actually take to put it on the road, and try to kick the tires a little bit. And yeah, policy, legal, and operational structures are very, very complex topics that are multifaceted, and driving consensus across these things is an ongoing challenge. I think we have made a lot of progress in the sense that a lot of the experimental work that we do refines these questions to a place where they are actually addressable, right? So just be able to now say, hey, what are the policy issues? We're actually able to say the policy issues are 1, 2, 3, 4, and they may be 1, 2, 3, 4 in one economy, they may be 4, 5, 6 in a different economy, but at least we're able to articulate them in a way that's concise and addressable. I can talk a little bit about what these issues are and how they're being a little bit of what the approach has been to them over time. But the general sense is that these things vary widely depending on the geography. So we've done 3 multi-CBDC projects, two in Asia, 1 in Europe. There are definitely more coming in different parts of the world. And while the technology, maybe has some slight nuances, the policy, legal, and operational issues generally vary very widely between different countries and different jurisdictions. I'll give you one example. When we think about policy and we think about monetary policy, specifically around monetary controls around your money sitting outside of your country. Different countries have a very different approach to these type of issues. And being able to build technology in these CBDC platforms that we can talk to different central banks and say, hey, if you want to conduct your policies like this, if you want offshore balances to be totally liquid and free, or you want to bring them in at the end of the day, or you want to put caps and restrictions on outflows or inflows, these are all tools that we can describe, at least at a technical implementation level, and kind of open and give the policymakers the ability to maybe not decide, but understand how their decisions will impact other parts of the solution. For example, legal. I mean, one of the interesting things about legal, specifically with multi-CBDC systems, for example, is what constitutes settlement. So that notion of settlement finality, specifically settlement finality in central bank money, is very, very important, right? It's that point of no return. After settlement finality, the transaction is not revocable anymore. Settlement finality, when you actually look at it in different jurisdictions, has a different legal approach in different jurisdictions. And then when we bring these together and create let's think about them as a common settlement platform, well, it begs the question: what legal jurisdiction does that happen in? Is it in one of the participants? Is it an offshore for all of the participants? If so, what offshore? And there's many questions that need to be asked, simply because now we have the technology and we're able to see how it works and how we could build it. And I think the operational issues are similar, right? And maybe the operational standards are slightly different, because the only distinction maybe with the operational standards is we're not building these things to operate for a year or two. If you look at large systems in the financial market, so let's say RTGS systems, real-time gross settlement systems that manage wholesale payments on a domestic level, these things generally have a lifespan of 20 to 25 years. So I think when we think about operations, it's not what does it take to run this in some MVP mode with a few, kind of private sector approach. Let's run this in a little sandbox and scale it up slowly and iterate as we make mistakes. No, we have to understand the operational standards for it to be rolled out at an international scale very, very quickly, and have governance and operational structures that will last the test of time. Right. So these things are complex. They're multidimensional. There's a lot of stakeholders, and there's a lot at the table. But I think that a very cautious, incremental approach is working well. And when I think about the headspace that I was in when this was written, I can generally say that we've made a lot of progress since then. Are we close to the end point? I don't think so, but I think I think we understand where the destination is.
Awesome to hear. Micky, take it away for the next one.
Yes, thanks, Alex. I guess before I do ask the next question, then maybe Daniel, I can ask you a question about what you were just discussing with regards to capital outflows, and I guess the implication of CBDCs for specific governments and how they're able to control the financial kind of stability of their countries. And I guess I'm thinking about one of the examples I'm thinking about is like the 90s with the East Asia financial crisis, where a lot of that, I guess, at least in hindsight or in reflection, a lot of that, one of the main reasons for it was some inability of these countries to completely restrict capital outflows, right, from their countries. And I think that has placed, for various other countries, one of the reasons we have high cross-border costs and even lack of efficiency is to do with this. I myself am Ethiopian, for instance, and Ethiopia has to have very strong capital controls because the currency is not that desired. We don't produce that much, so the government has to take a very active role in kind of how it manages its currency, and that perhaps doesn't come into such consideration. Developed economies, are you seeing these kinds of conversations in terms of some of the worries or the concerns that some of the countries have with respect to their own potential implementation or trials with CBDCs for their domestic currencies?
Yeah, absolutely. And thanks, Mickey, for just like bringing that to life at a personal level. You know, it's interesting to see, like, I mean, everybody has insight to this kind of depending on their context and where they come from and what their story is. So I think it's very interesting to hear the case for Ethiopia. What's interesting about a lot of these things is that, you know, there's no magic wand. There are things that can be resolved easier through some of these technologies, but then it could open up other issues around other things. So you know, let's talk about capital outflows for a second, because I think that's a great topic. So capital outflows in general is, you know, this ability to try to maintain your currency within your geographical boundaries, right? And it has to do with trade, it has to do with investment, and then it also has to do, like, on a personal level with citizens that maybe want to invest in foreign assets and things like that. When you think about the price of regulating capital outflows, a lot of that is because these regulatory structures, to a large extent, are kind of like, I almost want to say, bolted on to the system, right? And if you think about that, I can tie that a little bit into, like, the thesis of tokenization. And when you think about CBDC and you think about distributed systems and a lot of the work that we're trying to pull into the sphere of central banks, the general consensus is that these things don't need to be as expensive and as kind of after the fact as they are today, right? So you can design wholesale international systems that have capital outflow controls kind of built into the actual asset itself, right? So if you think about tokenization as abstractly as the ability not just to store value, but also to store the rules through which you are allowed to engage in this value, right? Then I think it's natural to say, well, if you don't have a certain credential, let's call that a credential of being a citizen of Ethiopia or being domiciled in Ethiopia, then you have a wallet balance that's denominated that has an upper bound on what you can hold. And the issuer of the currency can know ahead of time that their capital outflows controls will be adhered to, because there literally is no other way. You know, a silly example is like, it's like saying, oh, well, how do you keep the train on the tracks? It's like, well, that's what it does. I mean, we don't need anybody to do, it doesn't become so expensive, right? I don't need to hire somebody very expensive to make, I live in Switzerland, so there's a lot of trains. I think that maybe that example lands a little bit better here. But, you know, you don't, literally, it costs you nothing to make sure that the trains stay on the tracks. That's what they do. So could we design CBDCs with capital outflow controls that are predetermined, that don't cost a fortune to citizens? Absolutely. Are there other issues that open up? Absolutely. Because with that control, you could all of a sudden say, hold on, you know, well, how do I know that, you know, there's no mechanism so that if I hold currency outside of a certain country, that won't get kind of pulled away from me? Or, you know, there's a lot of issues around programmability and private. There's many issues that open up. So I don't want to paint this as this solves everything. It can solve many things, but it's, you know, it can equally open up issues to consider.
Yeah, I mean, I think. Oh, sorry, Alex. I was just gonna say that was a fabulous analogy. Really, actually makes a lot of sense. But I think at this point, that was a really great answer, because it really kind of focuses a question that in the past Alex and I have discussed as well. And that is around, like, what are we talking about when we're talking about CBDCs, right? Because I guess wholesale CBDCs are very different to more wide general retail CBDCs. And I think some of the questions or the points you were raising with respect to some of the rules and some of the programmability might make a lot more sense within the wholesale context, right? But might strike a lot more fear within a retail context, for instance, when we think about privacy issues or security. So I wonder if you could speak a little on the differences between these two kind of payment mediums and where the real kind of use case on the wholesale side is. Perhaps I think we've discussed some of the kind of retail opportunities, especially with the cross-border remittances side.
Mm-hmm. Great question. Thank you. So you're highlighting kind of two categories here: wholesale CBDC and retail CBDC. And the simple answer is that the only difference between them. So how are they the same? They're the same because they're both liabilities of the central bank. They're also the same because they're, of course, both digital. How are they different? Wholesale CBDCs have restricted access, generally thought as a tool to be used by financial institutions only. And retail CBDC is a kind of general purpose instrument. The analogy of these two things is retail CBDC is like cash. That would be the analogous central bank liability that exists today. And wholesale CBDC would be like the accounts that exist inside an RTGS system that are generally called reserve accounts. So that's kind of the anchor to the story. Now, this type of differentiation may seem arbitrary, and I would argue that there is a future where the lines between these things blur, and retail and wholesale isn't an issue anymore. A dollar is a dollar, a euro is a euro, a Swiss franc is a Swiss franc, independent of what system it sits inside. But if you want to have a little bit more of an intuition for these things, retail payments are optimized for very different things than what wholesale payments are optimized for. And my analogy that I like to give is it's a little bit like comparing a system of footpaths or small city streets to mega highways. Now, you could say they're both roads, and maybe there are certain cars that can drive on both. But, I live in Europe, and I'm telling you, there's cities that the big trucks can't get into and shouldn't get into. And a lot of people drive around these little tiny Vespas, and you don't want to see those on the highway, right? So it kind of depends on the use cases kind of mapped to the infrastructure. So we have to remember when we're thinking about this, we're thinking about infrastructure. And I think transportation is a very good analogy for payments, because it's not just about a single payment. It's also about all the cars moving all at the same time, and traffic flows and congestion and rules of the road and all kinds of things like that. So let's think about retail CBDC as the city streets of downtown London, and the wholesale things as the mega highways. So what are the things that we're optimizing for? When we think about wholesale systems, generally we're optimizing to minimize risk, specifically settlement risk and counterparty risk. Those are the biggest things. Now, I'll try to give kind of a practical intuition. If I was buying something from you, Micky, that cost $100, I could say, hey, yeah, I'll send you the payment. You ship me the, whatever. And yeah, it's all good. If there's any issues, we'll figure it out. But if I was buying something from you that costs $1 million, I'd probably go to your house. We would, I'd inspect the item, and I would try to release the funds in tandem with receiving the item, really to mitigate settlement risk. I also may do some background checks on you to reduce counterparty risk and things like that, to make sure that but generally it's about risk mitigation in the transaction. And the reason you want to mitigate risk is because settlement risk is real when you're moving hundreds of millions of dollars around. Now, to give a sense of scale, when we think about these payment versus payment exchanges, for example, that are payment versus payment means an atomic two-way payment, generally thought as two different currencies moving, trading against each other. So I give you dollars, you give me euros. I mean, the foreign exchange markets are in the trillions of dollars a day, right? Like, these are not small highways with a few trucks. These are massive highways with massive amounts of money moving around. So settlement risk is very, very real and very, very important to the wholesale payment industry. Alternatively, on the retail side, things are very different. Retail side's like people like us doing their everyday thing, and then the use of retail CBDC will vary widely depending on the jurisdiction, the users, and what they want. But in general, it's really about scale. You want to be able to support retail payments for an entire economy at scale. you really want to focus on things like privacy, which was mentioned, and many other cultural nuances that are connected to money. So privacy is probably the most potent one, but there are many, many other things that come into the fold very, very quickly. And then things like inclusion, innovation, and kind of embedded finance, I think are very, very important for shaping retail CBDC. And really it's about what role does central bank money what role does central bank money play in the digital ecosystem on a retail level? And the answer to that right now is zero. Central banks play no role in the retail digital ecosystem. It is all private sector providers that will only give you service if there is a commercial benefit. So that's fine, and that works well in many, many scenarios. And it is the private sector that will bring innovation and competition and drive not just payment solutions, but payment solutions that are a means to an end, right? It's not about making a payment. It's about what you're getting in return for the payment. It's about the service, the good or service that you're paying for. So the central bank by no means wants to play a more upfront role than needed. But the question is the central bank needed to provide that baseline? And different jurisdictions have different approaches to it. And I think that we're just opening up the realm of possibility.
Really interesting.
I hope that answered your question. I'm not sure. I think I went around it a couple of times, but hopefully I hit something there clicked.
No, absolutely.
Great answer, and thank you both for sparking that side topic. It was really interesting to hear both your knowledge on both of those subjects. And we talked a lot. You brought up a lot of comparisons with transportation infrastructure, highways, roads, tracks. So why don't we bring up another one, which is bridges? And it's clear that CBDCs and stablecoins, I think, there's a lot of exploration with how do you connect the dots between obviously these different countries who are experimenting with CBDCs. How will they transact value between one another? The idea of bridge currency or bridge currencies being needed is certainly something that comes to mind. Can you explain, Daniel, what bridge currencies are in simple terms and what role they might play in this future multi-CBDC landscape if it does emerge? And what really does a bridge currency in the digital first currency world look like?
Mm-hmm. Well, I don't want to disappoint you, but I probably won't be able to answer the last part of that question. I mean, I can make some general, I can give a general trajectory, but I probably won't be able to answer it accurately. I mean, a bridge currency, the definition is a currency that's an intermediary between two other currencies, right? So I want to move, let's say, Swiss francs to pounds. The question is, will I be able to do that one-to-one? Let's think it's not really a conversion, right? But will I be able to find someone in the UK that wants to take my Swiss francs, and will someone in the UK find someone in Switzerland that's willing to take their pounds? So the degree to which that connection can be made with an efficient pricing structure, there's really no reason for a bridge currency. Right? Because you can trade this asset against this asset, this central bank money against this central bank money. The practicality of it, though, is that if you think about the number of different currencies and how much liquidity needs to be available to make those transactions, it becomes less and less efficient because there simply often isn't enough liquidity there. And when I say liquidity, what I mean is depth of the market. It means that if I want to now send, 100 Swiss francs, maybe I'll find 100 Swiss francs for pounds. Maybe I'll find a counterparty. But if I want to send 100 million, I may not find a counterparty. So there isn't enough liquidity, maybe between Swiss francs and pounds, for me to send $100 million every day. But there may be more liquidity if we pool all of our liquidity into one type of currency. Now, there's a historical context of how that generally comes to be, how that currency comes to be. But once you pool all that liquidity, you can create more efficient pricing structures because you can say, okay, well, instead of looking for a counterparty directly, if I have the Swiss francs looking for the counterparty in British pounds, well, what I can do is just do Swiss franc dollar, dollar pounds, and Swiss franc dollar will have enough liquidity for my $100 million transaction, and pounds to dollar will have it. And then that currency becomes the bridge currency. So it's a very practical thing at the end of the day. It's really about liquidity. There's another side of it that also has to do with in what price are you going to denominate your assets. Everybody's heard about the petrodollar, so barrels of oil are being denominated in US dollars. Trade finance is generally denominated in US dollars. I mean, it's just convenient for everybody to anchor in one currency because it creates a common language. It creates a common hedging structure and risk structure. So it's really a very, very practical thing. When we look at multi-CBDC designs, and really what we're trying to look at is kind of diversification of these methods. So bridge currencies will always be there. They'll always provide a competitive exchange rate. They'll always be attractive. The reason they're there, though, is because of the deficiencies of creating sufficient liquidity or the issues with denominating things in different asset prices because the conversion is so tricky. But if there's technologies that maybe mitigate some of those problems, I think it calls into question the relevance, the future relevance of these bridge currencies. So, I'll give you a hypothetical example. If in the future we have common platforms that are connected across economies that can solve this kind of liquidity issue between currencies, hey, if Swiss franc to pounds will give me a better rate if I do it directly against each other versus going through the dollar or the euro or the yen or any other rich currency, then that's what I'll do. I mean, it's a very, very practical thing at the end of the day. And the motivation for this is, we hear a lot of things. I think, you can look at the digital euro that talk about strategic autonomy and payments, so wanting autonomy over their own payment systems. There's a general desire by most jurisdictions to denominate their assets. Think about government bonds, think about exports, things like that in their own price, because if you're denominating it in dollars, you're taking foreign exchange risk with your own exports in a currency that you have absolutely no control over. So there are very, very reasonable reasons to want to look at these type of tools more closely. And I mean, I can't really predict what the future will hold, but my sense is that there will be a more competitive, open, innovative approach to how we move around value. And I think that's kind of that would be really my only observation of the future going forward.
That's great. It's really fascinating. I guess my only follow-up to that would be what role, if any, I mean, you talk about bridge currencies, obviously, the USD has served that role primarily for a lot of different countries. Do you see a scenario where or what sort of value might digital assets, stablecoins, CBDCs provide in improving that role of the bridge currency? Do you see them being big game changers in terms of this idea of a bridge currency when, we have these digital assets in play more, and they're actually being, if they're being, more taken more seriously by the largest central banks around the world? Do you see them playing a serious role in those technological advances that might mitigate these problems?
So in supporting the functionality of the bridge currency?
Right. Yep.
It's interesting. I mean, I'll give you an example. We released this week a project called Project Mariana. And in this project, we looked specifically at, we envision a world where CBDCs exist. And we took 3 economies, Singapore, France, and Switzerland, and pooled their CBDCs in a common kind of offshore pool that was an automated market maker. And in that automated market maker, all the currencies could trade against each other. So I bring that example as like a serious departure from the way we think about foreign exchange today. Maybe, I mean, there's a lot of value moving around in the crypto ecosystem in that type of in these type of structures. Maybe that's something that's attractive for central banks moving forward, and we're really just starting to scratch the surface of those type of tools. So my intuition is that technology is only a part of it. Technology can open up new realms of possibilities. The US dollar isn't the US dollar only because of technology, right? It has many, many other facets to it. The depth of the markets, the rule of law, many, many things create the trust in the US dollar that you have that exists around the world.
Yeah.
I think as the technology advances, and technology is a part of this. I don't want to minimize the technology component of this, but the technology in general is kind of equally accessible to everyone. Maybe there's slight variations in form factors. So my sense is that rising tide will kind of lift all the ships, and the competition will likely be in things that are a little bit softer. Let's call them. So I don't think you decide which bills you use based on the fabric and the feel and what they look like. I mean, at the end of the day, it's where you live and what you have access to. But even if you could choose, it's more about which central banks you engage with, where you're doing most of your business activity, and that's the currency that you choose to deal in, right? So it's a very, very practical thing. So my sense is, I don't think it's a zero-sum game between bridging structures or direct structures. I think there's a lot of space for cross-border payments, and you asked about digital assets as well. So as we create more and more type of digital assets, as we maybe tokenize our deposits, maybe hold certain types of stable coins for payment needs that are very, very specific, my sense is that all of these things will bloom. A lot of times people think about currency competition, and currency competition is very, very real. Currency competition can exist between different forms of payment within an economy. Currency competition can also exist between different central banks and different fiat issuers. So currency competition is not a new phenomenon. Currency competition will continue to exist. Technology will probably make that competition more relevant and maybe even fiercer, but the beneficiary of this competition will be the users, right? And as long as we can keep the guardrails on, as long as we can not mess it up, right? And I think, when you think about the role of the BIS and the central banking community in general, right? That is the lens through which we look at things, right? This needs to work not just on the sunny days, but on the rainy days. And on the rainy days, that's the most important time where we test whether or not these type of things have the impact that we would like them to have. So I'm generally optimistic, and I think not looking at it as a zero-sum game is very, very important. There's no reason why your wallet, there is a reason today why your wallet can't hold 50 different types of currency. I'm not sure that there's a reason moving forward why it can't. And I'm not sure there's a reason why it can't provide real-time foreign exchange depending on what you are about to buy in the future as well, right? So just kind of open that up and say, maybe we're actually looking at this from a relatively narrow lens, and the future of payments is much more interesting and exciting than just these tiny movements that we think about today.
That's I love that answer. Thank you. We are obviously over the hour here. Daniel, do you have to run? I assume you have another meeting, because we don't need to finish all these questions.
I do.
No worries.
I've pushed my meeting back by 10 minutes. So I'm only 6 minutes late now. So it's okay.
That was a great way to end. Obviously, I want to get your answers to all these, but that was a great one to end on, I think. Micky, any other last minute thoughts?
I think just one last question from me, I guess. I think a lot of, when we've been speaking, a lot of the points you've made, Daniel, have been compelling. I think there is lots of opportunities and issues to be resolved within global financial services, and CBDCs, as you've highlighted, offer lots of promise for resolving them. But as someone who's kind of on the sharp end and, looking at the optimism, the potential and so forth, what does a rainy day look like for you, right? What are in your kind of day-to-day thinkings and musings and work on CBDCs, right? What is the biggest worry you have or challenge you foresee, or the thing that you think this is the piece that we really need to get right to make it possible?
Great question.
Oh, great question. I may give you a less optimistic note to end on there, but that's okay. It's good that I only have 2 minutes to answer this question. So a couple of things right off the top. Cyber risk is huge, right? Cyber risk also exists today, but as we bring more and more payments digital, as we increase access, as these things penetrate our systems more, the cyber risk becomes more and more real. We just published a report called Project Sela. That was a joint project between the Bank of Israel and the Hong Kong Monetary Authority, and that was looking at retail CBDCs access versus its cyber risk. So cyber risk is going to be and going to likely continue to be a huge issue. Another issue that is a lot of attention is being paid to is offline. And when I think about offline, it's not I want to buy a sandwich on an airplane that doesn't have Wi-Fi. I'm talking about, earthquakes, tsunamis, whole economies that are offline for an unknown amount of time with no previous notice. That is not a simple thing to solve, and that is definitely a rainy day that needs to be thought through carefully. Privacy is another huge one. So, there's a lot of reason to I don't want to say to be concerned, but there's a lot of reason to design privacy in payments very, very, very carefully. There needs to be trust that's built there. And privacy is a tricky topic because it's not just privacy at large. It's privacy of what and from whom. And if you sit down and think about that carefully, you very quickly come up with an entire matrix of privacy issues that need to be very, very carefully managed and very widely across jurisdictions as well, which may make cross-border payments a little bit tricky. The last thing is maybe a little bit of a curveball. A lot of people talk about interoperability, and interoperability is generally thought of as connecting disparate systems, and they speak of it as it only is positive. The more things are connected, the better, because we get more efficiency. When you think about your rainy day question, when you think about risk and risk spillovers, we just had the collapse of a couple of big U.S. banks. And one of the big things that we looked at the BIS was, what is the risk contagion of these type of things? And is it contained within certain economies, certain tiers of banks? So interoperability is really good. And there's a lot of force driving for interoperability. But what we need to make sure is that there's proper breakers in the system so that we don't have risk spillover, so that, a bubble here doesn't make something else explode on the other side of the world. So maybe those 4 points are some things that need to be drilled down a little bit more. And, we have a lot of work cut ahead of us, and we need the best and the brightest. So this has been a wonderful journey between the public and the private sector that I'm really looking forward to driving more.
Yeah. What
back
fun
to our
work to
road
be a part of.
analogy.
A lot of road analogies there. All right. Thanks so much, Daniel. Really great to hear from you. And thank you so much for joining us on Converge. We'll hope to get you back in the future. Appreciate your time.
Awesome. Thanks for having me, guys. This was great.
Oh, our pleasure. Take care.
Thank you, Daniel.
Thank you.